Hey everyone, Richard Norris here, and in today's video I want to talk to you about the autumn 2023 statement that was released by the Chancellor Jeremy Hunt in the UK Parliament on the 22nd of November 2023. Now, I've got some super exciting news for you coming up as a UK property investor, because what Jeremy Hunt announced in the autumn 2023 statement is really a paradigm shift and is revolutionary. So throughout the video today I'm going to explain to you what is the autumn 2023 statement, what were the main points in the autumn 23 statement that affects us as UK property investors, how we can benefit from the autumn 2023 statement and the impact that it will have on us as growing property portfolios across the UK. So now, before we jump into the video, for those of you who are new to my channel and for those of you who don't know me, my name is Richard Norris. I've successfully built a multi-million-pound property portfolio in the UK. I've recently diversified my investments and I now am an international investor. I've been investing in property for over 12 years and I'm the founder and CEO of a company called propertyconsulting.io, and we've helped thousands of clients to start and grow successful real estate property portfolios in the UK, and we've also helped existing property investors to scale their property portfolios as well and optimize their returns and make them more tax efficient and streamlined so that they can hit their own individual goals and parameters for growing their own property portfolios. So let's jump into today's video then. So what is the autumn 2023 statement? Well, every year there's budgets, and the budgets get released by the Chancellor, by Parliament in the UK, which is effectively the government, and they basically tell you like what you can and can't do, what the news, rules and regulations are in the UK around certain things, and they cover various topics from pensions through to property through to just basic government agendas that really run the UK economy and how it's going to be governed by law. Now, why is this important? Well, as a property investor in the UK, it's super important that you keep up to date with these things and understand exactly what happens in each budget. And in the example, in this autumn statement, it was released. Usually there's 2 budgets per year, but sometimes they'll put a supplementary statement in place, which effectively is a budget. So the autumn 2023 statement is a budget, and they put it in place when there's a period of chaos. And like right now, as we've seen in the UK, maybe entering a recession, well, in a recession, I shouldn't say maybe entering, we're in a recession, and interest rates are kind of fluctuating up and down, steeply climbing as we've seen over the past few months. And the UK economy, quite frankly, right now is in a bit of a mess. And so the Chancellors, the UK government and Parliament have put together the autumn 2023 statement to outline new initiatives and new parameters that are basically going to affect us as a property investor. So I want to cover off all of those topics today, how it will impact us as a property investor. And really at the start of this video today, I'm going to talk about the 5 to 6 main points that were announced in the budget that affect us as property investors. And then I'm going to, at the end of this video, talk about the main one, which I'm really excited to share with you because it's huge news for us as property investors. Like I said at the start of this video, it really is revolutionary. And I'm going to explain that as we go through the video. So if you're into property investing, you're looking to grow a UK property portfolio, right now is going to be very exciting times for you. And certainly for myself and my clients, we're really looking forward to implementing and taking action on growing our property portfolios aggressively in 2024 because of some of the recent announcements which I'm going to talk about in the video today. With that being said, and before I jump into the points, if you are new to my channel, please go ahead, click the bell icon so that you can stay notified of weekly content and be updated on any property related information that I bring out on a weekly basis. Please go ahead and click that like button as well. It will really help us to grow our channel, and I'd really appreciate it if you do like the content, just give it a genuine like. And equally at the same time, if you haven't already and you are new to my channel, please make sure that you go and subscribe as well so you can follow our content. So without being said and without further ado, let's jump in to the very first point that I want to make about the first budget, which is all about inflation. So the very first point that was covered in the autumn 2023 statement, in my points here that I've taken from watching this statement and reviewing it, is inflation. So the Chancellor Jeremy Hunt talked about inflation, and he talked about the reduction of inflation. Specifically, what he said is that inflation has halved and it's currently at 4.6%. Whilst this is good news, and whilst it's great that the inflation in the UK is starting to settle, we still have to understand that inflation is still over double what the Bank of England want it to be. So the Bank of England's target for inflation is to get inflation to settle to around 2%. And as of the autumn 2023 statement, it was reported that inflation currently sits at 4.6%, so 2.6 percentage points above where it needs to be. What does this mean to us as property investors? Well, effectively what it means is that interest rates are going to remain still relatively high. They're still going to remain solid, which is disadvantageous to us as property investors because high interest rates mean costly and expensive mortgages, which obviously eats into our profits. However, it's not all doom and gloom because, like I said at the end of this video, I'm going to talk to you about how we can offset that with one of the golden nuggets that was released in the autumn 2023 statement. So sit around and make sure you stay to the end so you can understand how to benefit from that. But with that being said, going back to the point about inflation, it basically means that interest rates are going to remain high so that we can stabilize the UK economy, growth and employment structure. Okay, so during periods of high inflation, interest rates will rise to try and settle and quantitative ease the market and settle inflation. So we're going to see interest rates remain high. Now, recently, the base rate remains at 5.25% across England. This is the base rate that all mortgage lenders work to and work against. And the Monetary Policy Committee came together on the 13th of December 2023, recently after the autumn 2023 statement, and they concluded with 6-3 on the votes that they would basically remain and keep the base rate at 5.25%. So the base rate has remained the same in the last announcement from the MPC, the Monetary Policy Committee. Okay, so what does that mean? Well, currently I looked on the website just recently here in front of me and I looked at the mortgage works. I wanted to see, what are the current rates at the moment on the market. And as of today, as of this recording, the current rates range between 5.19% all the way through to around about just under 6% on a traditional buy-to-let mortgage on an interest loan basis at 75% loan to value. Okay, so I'm just going to refer here to exactly what the rates are so you can have an indication as a property investor what inflation means to you and how this affects us. So the current rate at the moment, you've got a 5.19% 1 or 2 year fixed rate with TMW, the mortgage works, with a 3% product fee. So you might be thinking, well, if the base rate's 5.25%, how can the mortgage interest rate be 5.19%, which is lower than the base rate? Well, the reason that works is because the lender in this scenario has put a 3% product fee on top. So most of the time, the product fee will be added to the loan and you'll be paying interest on the 3%. And that's basically how the lender's still able to make profit, even when the base rate is at 5.25% and charging slightly under the base rate of 5.19. Okay. Now, the next product that they have available right now is 5.49% on a 5-year fix with a 3% product fee. And then they also have their current rate is 5.74% on a 2-year tracker and a 3% product fee. Now, the last product that they have available on their website today is 5.99%, so slightly a more expensive loan, but there is no product fee. So actually, if you were to compare all of those loans, you would probably see between the 5.19 and the 6%, if you ran the calcs, that they're not too much different actually, because the time you put the 3% product fee on top of a 5.19% rate, and you break that over the mortgage term, the interest monthly payments are going to be pretty similar. Okay, and you'd have to do the maths to work out what that's going to be, which I'm not going to do in this video because I just want to inform you today about the autumn 2023 statement and the news, the announcements, and how that's going to impact you. So the first point there is inflation, which basically means that interest rates are going to remain high for this period of time. However, what we expect to happen and what the money markets have alluded to is that they think in 2024, towards the end of 2024, the base rate, the Bank of England's base rate will drop 1 percentage point from 5.25 to 4.25, which will have a positive impact along with the golden nugget that I'm going to share with you at the end of this video, where the government made a huge announcement, which is extremely revolutionary to us as property investors, and it's going to be very beneficial for us in 2024, along with the reduction in the percentage, 1% decrease in the base rate as well. The next thing, the second point that I want to talk about in this video today that was released in the autumn 2023 statement is all about the LHA rates, and they've increased. So LHA stands for Local Housing Authority, and effectively the rents that we can charge to the local housing authority. So if you're a social housing landlord in the UK and you own social housing property and you've basically got maybe a contract with the government or a Ready Homes, Mears Group or a Serco contract, the good news is that the LHA rates are going to be increased. That means you're going to be able to charge more for those specific properties in terms of the rent that you're receiving as the landlord. Now, this is really good because they recently froze the LHA rates. They've been frozen for a while. And what they basically came out in the autumn 2023 statement said is that based on the sudden surge and increase that we've seen in the private rented market, where rents have gone extremely high over recent years, much higher than the rate of the LHA rates, they've said that from the 1st of April 2024, So in Q1 next year, we'll be able to increase the rent that we can charge to the local housing authority on a social housing contract. So this is great news for you as a property investor if you have social housing contracts, like I alluded to, because you're going to be able to make more money, you're going to be able to be more profitable because you're going to be able to charge higher rents, more in line with the private rental market. So this is good news. The next thing I want to talk about, and the third point I want to cover really quickly, is corporation tax. So if you're a business owner in the UK and you own a property portfolio, I would recommend that you invested in property through a limited company, because it's the most tax efficient vehicle when you break it down. Even if you're a lower rate taxpayer, yes, you might only pay basic rate tax at 20%. You don't have Section 24 finance restrictions. The overarching generalist advice would be, if you're growing a property portfolio and you're looking to make it profitable and build wealth, then build that wealth through a limited company. If you're investing in UK property and you've got to use a UK tax vehicle, I would suggest a UK limited company, which basically means you pay corporation tax. The latest autumn 2023 statement said that corporation tax is going to remain at 25%. It was 19%, and then the budget earlier on in 2023, earlier this year, the budget changed that from 19% to 25% corporation tax. In this statement, they've kept corporation tax at the same, so corporation tax remains the same at 25%. The next thing I want to talk about, and the fourth point I want to talk about today, is really about business rates. Now, in my personal opinion, commercial property in the UK isn't the best investment commodity to invest in right now if you're a property investor. And one of the reasons for that is because actually the business rates on commercial property is extremely high and it's expensive. And during COVID, a lot of landlords who own commercial property suffered quite a lot of losses in rent, because businesses weren't able to afford, or businesses weren't paying during COVID the rents to commercial landlords. And of course, because business rates are expensive, because inflation is high, naturally the people that struggle the most in the market are usually your small business owners, your small medium enterprises. Okay, so if you're a commercial landlord and you're renting out your property to a, let's say for example, somebody who owns a boutique small coffee shop who's a startup, the business rates that they're paying at the moment on those properties is expensive, which means that it's less attractive for people to get into business and occupy these types of premises. So whilst that's kind of negative for us as property investors, if we're solely investing in commercial property, there is an upside to this. Now, in the autumn 2023 statement, the Chancellor said that he would reduce business rates, but I don't think it's going to be significant enough to make basically any big impact to bring back the commercial sector, in my opinion. And if you want to know what I'm doing, I'm not investing in commercial real estate right now for those reasons. What I am doing a lot of, though, and what I would like to allude to and share with you is we're converting those commercial premises into residential dwellings under permitted development rights. This is an excellent opportunity actually, because a lot of this commercial property is empty at the moment, so we can, under permitted development rights, convert an office building, for example, into C3 residential dwellings. So I do a lot of office blocks, I take a lot of commercial property and I convert it into apartment blocks. I refinance it and I hold the asset for rent. So that's one of the strategies that you can deploy, is commercial to residential developments, for the reasons that I've alluded to here. So recently this year as well, which is why I recommend doing the commercial to residential development strategies, because Michael Groves earlier in this year talked about enhancing the PD rights for commercial to residential conversions. So we don't know exactly what they look like right now, but in the autumn 2023 statement, it was suggested that in April next year, in Q1 2024, there'd be more insights into the enhancement to PD rights for property investors to convert property under permitted development from commercial to residential use. So there's an advantage for us. That's a good thing as well. Yes, business rates are expensive, but we can capitalize on the opportunity, which is what I would encourage you to do. If you're thinking about getting into property, or you own commercial property and it's sat empty, you're paying high business rates, think about how you can optimize the space through permitted development rights and change it into residential use. Now, the fifth point that I really want to cover and talk about from the autumn 2023 statement is planning fees. So in the autumn 2023 statement, what they said was that the planning fees for the LHA, so the local housing authority, are going to be able to charge property developers on business planning applications. They're going to be able to charge more. So it's going to come at a premium cost. And we believe that the prices for planning applications, on business planning applications for property developers, is going to go up in the region of about 25%. Why is this a good and bad thing again? So we'll start with the negative. The negative obviously is that we're paying more money for the planning application. So we've got a 25% uplift in a cost to do a planning application. As a property developer and as a property investor, obviously that's not beneficial to our balance sheet, affects our profits, and at the same time affects our return on investment. However, one of the reasons that the Chancellor has brought this in is because he wants to incentivise the local housing authority to speed up the planning process. And this is obviously a good thing. At the moment, if you put a planning application in the UK, if you've done it before as a property developer like myself, you'll know that it can take months and sometimes years to get planning on things. And sometimes it can be laborious even just to get a response. Now, the whole purpose of the Chancellor bringing in the increased fees is so that the local housing authorities and the government and local councils who are approving the planning applications or rejecting them, basically reviewing the planning applications, have to respond in a certain time frame. And I believe that the time frame is going to be 8 to 12 weeks. They're going to make it extremely responsive. And he's saying that if the LHA don't respond in a certain time frame, then you can basically get a full refund. So, the advantage there is to us as property developers is that it can speed up the process, it can make it more innovative, more fast moving, which is obviously better for us as a business because it becomes more efficient. And at the end of the day, time is money. So the time essence of if we can get things approved quicker than previously should offset the increase of 25% in the planning application cost. However, it could work in your favor or not as well, because we don't know yet. What needs clarifying, wasn't clarified in the autumn 2023 statement, is what planning applications are going to have this uplift in cost. If you've got a big site and you're delivering 100 homes and it's a 25% uplift on the planning cost, well, on 100 homes at scale, that can be kind of eaten up and will have a less impact on your feasibility study and your profits. But if it's a small planning application you're putting in, let's just say that you're trying to change the facade of a commercial shop or change the appearance of a residential dwelling, and for whatever reason you need to put in a planning application and you've got to pay a 25% uplift in costs on a small planning applications like that, the uplift might not be significant. So, the increased cost might adversely affect your ROI and the profitability. So, depending on the planning application that you're putting in, depending on the site that you're doing, the development that you're doing, obviously the impact of these rising costs will be subjective to the development. But overall, I think it's a good thing. I think it's a good move in the right direction, because at the end of the day, money loves speed, and actually it can be extremely painful and extremely frustrating as a property developer in the UK because it's slow and arduous at times. So I think being a bit more innovative, being a bit more revolutionary, speeding up the process is beneficial to us as property investors. We can get things done faster, which is always a good thing in business. The last thing that I want to speak about in today's video, and the golden thing that I want to talk about as property investors, the revolutionary thing that's going to change the game for property investors in 2024, is in the autumn 2023 statement, Jeremy Hunt suggested that there's going to be a consultation. It's supposedly going to come out in April 2024. What he said was this. He said, for the first time in history, as property investors in the UK, we're going to be able to change a residential dwelling into 2 flats under permitted development rights without having to get planning permission. So this is huge, huge, huge news for property investors. And the reason that this is huge news for property investors is because for the first time in history, we're able to subdivide a property. Okay, so we're able to subdivide a property into 2 flats. We've not been able to do this before. There has been permitted development rights on residential property in the past, and there still remains today, but it's been all about increasing the footprint of the residential dwelling. So for example, you can go up and do a loft conversion if you meet the criteria to do that under permitted development, or you can do a single story extension to the rear of the property. But we've never ever before until now been able to subdivide a property and take a residential dwelling into 2 flats. Now, why is this so good as property investors? Well, remember at the start of this video, I talked about interest rates being, high because of inflation. Well, the problem of that is if you're a property investor in the UK, you'd have experienced this when you run your calculations. If you're buying a traditional 2-bed property or 3-bed property, or even a 1-bed apartment, and you're renting out a single dwelling, on a buy-to-let property, and you're taking out a mortgage at 75% with an interest rate between 5 and 6%, the yield on the asset, even if you invest in the northwest of the UK or northeast of the UK, might only be 7 or 8% as an absolute maximum. Now, if you're investing in the southeast of the UK, places like Oxford and London, your yield on those sorts of asset classes is only going to be 3, 4, 5% at max. So if your yield is lower than your mortgage interest rate that you're paying, or even if your yield is slightly higher, but only just slightly higher than the mortgage interest rate, of course, your profitability as a property investor, by the time you take your rent in and you pay your interest-only mortgage on the increased amount, means that your profit is really been reduced, which obviously isn't good for us as property investors because we're in it to maximize the return on our investment as well. I think that's all fair and reasonable that as property investors, one of the reasons we invest into property is because we want to make good returns on our investments and want to make good returns on our money and get our money working as hard as possible. Well, of course, these high interest rates to try and settle inflation has adversely affected us as property investors if we're leveraging money on buy-to-let interest-only mortgages up to 75% loan to value on a single asset class, 2, 3, even 4-bed properties, renting out to a single occupant or a family, for example. We cannot force the yield high enough to offset the mortgage interest rate, so the profits have become reduced. Well, having this permitted development rights, being able to change a residential dwelling into 2 flats without having to get planning permission, changes everything. Because we can now get 2 rents on the same property, which means that we can force the yield up from, say, 3, 4, 5% in the southeast to maybe 6.5, 7%. And in the northwest, where we're getting 7% yield, for example, we can force that yield up to 9%. And now we get back our margin as if interest rates were around 3%, 3.5%, which was the case before the interest rate hikes really started to come into play this year, and where we saw the base rate of England go massively up from 0.25% all the way up to 5.25%. This is going to be able to offset that. So this is huge, huge news. I mean, I'm really excited. So if you're a property investor and you're someone like myself and you live in, say, Oxford, obviously I don't live in Oxford anymore. For those of you who don't know me, I'm living in Dubai. However, I was born and raised in Oxford and lived there for 32 years. So if you're investing in places like Oxford or London, areas of high capital growth where the yield is low, you might buy a property for anywhere between £300,000 and £450,000 as a single dwelling, maybe a 2 or 3-bed property. Then, actually it's going to have a bigger impact to be able to split a residential dwelling like that into 2 flats, because you can significantly enhance the value and enhance that yield more than you would be able to in the northwest or northeast of the UK, because properties are already cheap. However, with that being said, it doesn't really matter too much, because even in the northwest and northeast where properties are cheap, you can still increase the yield and collect 2 rents on 1 property, which is obviously beneficial to our position when we're looking at return on capital employed and return on capital invested in our ROI as property investors. So this is huge. This is huge, huge groundbreaking news in my opinion. And I'm super excited, like I said, in 2024 to go after this strategy and use those permitted development rights, because I think it's an excellent opportunity for us as property investors to capitalize on the market and make the benefit and the best use of the opportunities that are in front of us, right? Now, the only thing I would say, you need to act fast. And the reason that you need to act fast is because I think in places like Oxford and London, they'll start to introduce Article 4, and the local housing authorities in those specific regions will apply for Article 4, and effectively what that will do is means that they're applying for exemption so that they can basically get rid of the PD rights, which sounds counterintuitive when Parliament have put this in place, but I think that the local housing authorities in certain areas like London and Oxford will start to put in that Article 4. So you need to be fast, you need to act fast. Like I've said, and like I say in my video, money loves speed, and in business you need to act fast. And if you want to become wealthy, honestly, I've observed and studied wealthy people, and I've learned that you need to make quick decisions. You've got to be fast. So that would be my key advice to you. If you want to capitalize on the opportunity in 2024, make sure you're fast moving and make quick decisions. So with that being said, that wraps up today's YouTube video. I hope you liked it. If you did like it, please go ahead and give that thumbs up. If you're new to the channel, make sure you subscribe and make sure you click the bell icon for notifications. Just a quick summary before I exit. So the first thing was inflation. We talked about inflation. We talked about the effects of inflation. Although inflation is halved, we're still not where we need to be. We're still over double percentage points of where the Bank of England wants it to be. That means interest rates are going to remain high. The second thing that we talked about was LHA rates and how they've increased, which is beneficial to us as property investors if you're a social housing investor. We talked about corporation tax remaining at 25%. We talked about business rates being slightly reduced, but the opportunity for commercial to residential development because of commercial business rates being high, and the reduction not being significant enough to make any material impact. And we talked about Michael Grove's introduction of enhancing PD rights in Q1 2024, expected to be around April time. And then we also talked about planning fees for property investors and how the planning fees have been increased and augmented, although that has pros and cons, which I alluded to in the video. And lastly, we talked about the biggest golden nugget and the most exciting news for us as property investors from the autumn 2023 statement was when the Chancellor said and alluded to a consultation that would materially come into effect in April of next year in 2024. PD rights on residential dwellings to subdivide properties into 2 flats. All right, so I hope you enjoyed the video, and I'll see you in the next one.